So again, this dependence on economic indicators, which may be distorted by seasonal factors gone wild during COVID and an inability to adjust them accordingly, could be distorting some of these numbers. The second variable, valuation, very dependent on interest rates, which in turn are dependent on inflation. And you know what we think, but the bears think we're going back to a 70s style inflation and valuations dropping to those levels. That is the essence of the fight taking place, this tug of war as we try to bottom up in the market, bottom out. I think watching prices, real-time indicators, supply relative to demand is going to get us to the right answer faster. And right now, we'll go into it in a minute, those indicators are showing in some cases signs of collapse. So the interesting thing, and we are keeping in fixed income, we are keeping our eye on the 10-year. It peaked at 350 in mid-June, just about the time the stock market bottomed, and got down to 250. We went down 100 basis points by early August. We're back at 320 today, again, because of the Fed's hawkishness. So, the short rates moving up and long rates kind of following, not quite as quickly. The yield curve still negative, not as negative as it was, but still negative, and that's important. So we believe longer term, if we're right on our deflation call, that we're going to get back to 2% long-term interest rates. And what's very interesting about that from a equity valuation point of view, I've been struck through my career, through all the period of disinflation, as they have called it, since 1981 until recently, that the market, the PE ratio of the S&P 500 could never really get above 20 to 25 times, even in the best of markets, the strongest of markets with the lowest inflation and so forth. And that's because there was this disbelief that inflation was really in the 1 to 2% range, where it was for quite a while. Most people thought the normalized or it's not even inflation, it's GDP growth. Normalized GDP growth is 4 to 5%. Most people think, say, 3%, 2 to 3% growth and 2 to 3% inflation. I just do a quick back of the envelope to try and figure out at different interest rates where the PE ratio should be. And historically, you go 1 over the interest rate. So P, this is for bonds, price, over E, earnings in the bond market. If we're at 3%, you just take the inverse of that. That's a 33 times multiple. Well, we've never gotten there. And that's because no one believed that inflation and interest rates truly were embedded in the system close to that 2 to 3% range.